Wall Street looks calm, indexes near record highs, and headlines talking about new bull markets. But that calm is exactly where hidden risks start growing. In fact, fund managers' cash holdings hit historically low levels in early 2026, meaning most investors are heavily positioned in the market with minimal safety buffers, which usually precedes sharp downturns. Despite solid year-end gains in 2025, with the S&P 500 up over 16%, Nasdaq up more than 20%, and the Dow up 13%, Wall Street wasn't as tranquil underneath. Significant market volatility occurred throughout the year, including sharp sell-offs linked to trade tensions and geopolitical risk, and investors continue to worry that many stocks are overvalued relative to economic fundamentals. The first deep risk to understand is market complacency. Calm markets do not mean stable markets. When volatility is low, many investors believe risk is gone. But academic research on leverage shows precisely the opposite. Long stretches of calm encourage borrowing and speculative bets, which makes markets fragile. If prices fall even slightly, leveraged positions face margin calls and forced selling, amplifying declines into bigger crashes. This concept, known as the Minsky moment, highlights how stability can unintentionally set the stage for sudden collapse. So, if calm is dangerous, how do we measure that danger? One of the most critical tools is the VIX, the volatility index, also called Wall Street's fear gauge. When the VIX rises, it shows that traders expect more price swings ahead. In April 2025, the VIX spiked to levels not seen since the pandemic, signaling that investors were pricing in much more uncertainty, even if stock prices themselves hadn't crashed yet. This disconnect between price levels and perceived risk is exactly why seeing a calm chart doesn't mean safety. It can mean pent-up fear waiting to erupt. Another major risk factor today is concentration risk and speculative bubbles, especially in technology and AI-related stocks. Bank of America's recent survey of fund managers listed AI valuation bubbles as one of the top tail risks for markets in 2026, highlighting concerns that capital flowing into a few favorite names could reverse quickly if earnings fail to justify lofty prices. And the systemic side of risk doesn't stop there. The International Monetary Fund, IMF, has warned of the rising odds of a disorderly global market correction because of stretched valuations, geopolitical tension, and tight links between banks and less regulated financial entities like hedge funds that could transmit shocks rapidly across markets. This means a shock in one sector, trade policy, credit markets, or inflation expectations could ripple faster than ever before. That brings us to another paradox: low volatility, high risk. According to market analysts, when implied volatility, like the VIX, drops, many traders reduce protections like options hedges and increase speculative positions, assuming the calm will continue. But this complacency cycle actually plants the seeds for future spikes in volatility because risk becomes concentrated and unprotected. When volatility eventually returns, it tends to spike quickly rather than gradually, catching many off guard. But if markets are risky, how should investors think about strategy? First, it's crucial to monitor risk indicators, not just prices. Tools like the VIX, leverage ratios, liquidity measures, and sector concentration stats can reveal hidden tension behind calm price moves. Second, top investors like JP Morgan CEO Jamie Dimon have publicly expressed concern that the possibility of a market correction is higher than many expect, emphasizing over-optimism and geopolitical uncertainty as key catalysts. This leads to a strategic question for you. Do you base your belief in market safety on price charts? Or do you watch risk signals and fundamentals like debt levels, market breadth, and implied volatility? Comment below with your strategy. Are you a dip buyer, a risk manager, or someone focused on long-term fundamentals? Let's spark a real conversation on how investors should navigate Wall Street risks in 2026. Because at the end of the day, understanding that calm can hide danger is one of the most powerful insights an investor can have. If you want clear, honest analysis of market volatility, hidden risks, and investment strategies that go beyond headlines and noise, make sure to subscribe to this channel and hit the bell. By subscribing, you'll get advanced insights before everyone else, not after the next market storm hits.